Hey there, thanks for stopping by. You've stumbled upon our new student loan education course. Here at LendEDU, we're committed to helping borrowers and their families navigate the intimidating student loan market. In this series, we tried to feature a variety of topics important to understanding student loans. Now, we don't need to spend hours covering these topics, so each video is short and to the point. If you'd like more in-depth explanations of any of the topics covered in this series, head on over to the resources section at lendedu.com. Enjoy! You may have heard of the FAFSA, but unless you've actually filled it out before, you may be a bit overwhelmed. The free application of federal student aid, or FAFSA, is the form the U.S. Department of Education requires to determine your expected family contribution, EFC. The government conducts a need analysis based on financial information such as income, assets, and other family information, which you and your parents, if you're a dependent student, will be asked to provide. Most universities and colleges require all of their students to submit the FAFSA to obtain financial assistance such as college-sponsored financial aid, including grants, educational loans, and work-study programs. Before submitting the FAFSA, the applicant can select the financial aid offices that should receive the application. Once the FAFSA application has been submitted, the financial aid offices selected will be able to view the results. To qualify for federal financial aid, students must be a U.S. citizen, a U.S. national or an eligible non-citizen, have a valid Social Security number, have a high school diploma or GED, are registered with the U.S. Selective Service if you're a male ages 18 to 25, do not owe refunds on any federal student grants, are not in default on any student loans, and have not been found guilty of sales or possession of illegal drugs during a period when you received federal student aid. What is expected family contribution, or EFC? The constantly rising cost of college is tough for students and their families. These days, most families will be eligible for some type of financial assistance that could help pay for school. With limited resources available for families, the expected family contribution, or EFC figure, was created and designed to help. The U.S. Department of Education defines EFC as an index number that college financial aid staff use to determine how much financial aid you would receive if you were to attend their school. The U.S. Department of Education reviews the FAFSA and provides families with their EFC. EFC is influenced by family income and investments. Income means more than a paycheck. Income calculations can include Social Security benefits, combat pay, and even contributions to retirement accounts. The amount of money a family can contribute might also be heavily influenced by the number of students in a household attending school in a given year. While many families have only one child to send to college, those with multiple students in college could see their EFC drop as a result. What is a grant? What is a loan? What's the difference? Great questions. A grant is a sum of money awarded to you based on financial need or other criteria, such as academic merit or athletic ability. In the latter case, these funds are sometimes referred to as scholarships. Grants are usually the best form of aid because you don't have to pay them back. There are many sources of grant and scholarship aid, including the federal government, state agencies, colleges and universities, and private organizations. In contrast, loans are forms of aid that you must pay back. There are many types of loans, including Direct Stafford, Perkins, Parent Plus, and alternative private loans. Some states also sponsor loan programs. These funds must be paid back with interest. Usually, repayment begins after you've completed school and a grace period, but sometimes it's expected right away. A Stafford loan is a federal student loan offered by the Department of Education to undergraduate and graduate students. Stafford loans provide students with financial aid to help pay for the cost of their education, including tuition, books, and living expenses. There are two types of Stafford loans available to undergraduate and graduate students. The first being subsidized Stafford loans. Subsidized Stafford loans are awarded on the basis of financial need and carry the benefit of subsidized interest. The federal government pays the accrued interest while a student is in school. Unsubsidized Stafford loans are not need-based, meaning any student who submits FAFSA is eligible to receive aid. However, because these loans are unsubsidized, the student is responsible for paying any interest that is accrued while in school. For the 2014-2015 academic year, the federal government set the interest rate for subsidized and unsubsidized Stafford loans at 4.66% for undergraduates. Graduate students will pay a higher interest rate of 6.21%. To apply for a Stafford loan, the applicant needs to be a United States citizen, must have a Social Security number, SSN, and a high school diploma or GED. The Federal Perkins Loan Program provides assistance to qualifying students who can demonstrate financial need and who are seeking a higher degree through an approved post-secondary school. Perkins loans have low fixed interest rates and manageable repayment terms. Similar to other types of federal loans, Perkins loans can be used to cover education-related expenses such as tuition, textbooks, and housing costs. Perkins loans are designed for low-income students enrolled in an undergraduate, graduate, or vocational program at an institution that participates in the Perkins Loan Program. Not every school offers Perkins loans to its students. You should consult with the Financial Aid Office to find out if the program is in place. In comparison to other federal loan programs like the Direct Plus and Stafford loans, very few Perkins loans are issued to students each year. Only $500,000 in new Perkins loans were issued in 2014, with an average loan amount of $1,700. Borrowers are responsible for repaying a Perkins loan with an interest rate of 5%. The repayment period of a Perkins loan is 10 years. Borrowers can apply for a Perkins loan by filling out the free application for Federal Student Aid, FAFSA. As a parent, the task of saving for college is becoming more difficult by the day. Keeping up is tough. To help parents contribute to their son's or daughter's education, the federal government created the PLUS loan. A PLUS loan is a student loan offered to parents of students enrolled at least half-time in eligible programs at participating and eligible post-secondary institutions, or graduate and professional students at participating in eligible post-secondary institutions. Now, in most cases, parents must pass a simple credit check. The credit check only tests for adverse credit history, such as default on a prior federal student loan, not for a favorable credit score or debt-to-income ratio. PLUS loans are available to cover up to the full cost of attendance, minus any financial aid received by the student. For example, if college costs $22,000 a year and the student has been offered a financial aid award of $12,000, the parent is eligible to request a PLUS loan of up to the amount of $10,000 for that year. Stafford loans offer lower interest rates than PLUS loans, so it's usually best to maximize Stafford loan limits before using the PLUS loan. With the rising costs of education, many students find themselves using private student loans to help cover the cost. A private student loan is a financing option that can either supplement or replace federally guaranteed loans such as Stafford loans, Perkins loans, and PLUS loans. Although traditionally unsecured, these loans are becoming increasingly secured, so that the borrower must offer collateral or have a qualified cosigner. Interest rates are set by the financial institution that underwrites the loan. Interest rates offered are typically based on the perceived risk that the borrower may be delinquent or in default of payments of the loan. The underwriting decision is complicated by the fact that students often do not have a credit history that would otherwise indicate credit worthiness. As a result, interest rates may vary considerably across lenders. Cosigner credit worthiness may be a big determinant of approval. Because private student loans are subject to special treatment in the event of personal bankruptcy, students may not incur a total debt in excess of the cost of attendance, taking into account scholarships, fellowships, federal loans, and private loans. Before using private student loans, borrowers should research federal student loan alternatives. Many lenders require borrowers to apply with a cosigner. What is a cosigner? What are the benefits of having a cosigner? Well, a cosigner is a parent, grandparent, guardian, or other adult who is creditworthy and willing to assume legal responsibility for the loan liabilities along with you. In most cases, the cosigner must be a U.S. citizen or permanent resident. Cosigners may have to pay up to the full amount of the debt if the borrower does not pay. Cosigners can usually be removed from the loan upon consecutive payments during the repayment period. Cosigners are taking a risk. In exchange for taking the risk, lenders are able to offer borrowers lower interest rates. Lower interest rates can save borrowers a significant amount of interest payments over the term of the loan. What's the difference between a variable interest rate and a fixed interest rate? Great question, and an important one at that. A variable interest rate student loan has an interest rate that has the potential to change over the term of the loan. Variable interest rates are calculated based off an underlying interest rate index. As market interest rates move up and down, the interest rate you pay on a variable interest rate loan can also vary. As a borrower, you're directly exposed to these changes. A fixed interest rate student loan is pretty straightforward. Over the course of the loan, you will pay the same interest rate no matter what. If you're offered a 5% interest rate for 15 years, you will pay 5% interest in every year for 15 years. In comparison to variable interest rate loans, fixed interest rate loans will generally have a higher interest rate at the time of borrowing. Origination fees are an important and sometimes a costly characteristic of consumer loans. Origination fees are upfront fees charged by a lender for processing a new loan application. These fees are used as compensation for putting the loan in place. Origination fees are quoted as a percentage of the total loan. An origination fee is similar to any commission-based payment. For example, if a student loan lender takes a 1% fee for originating a loan, they will make $100 on a $10,000 loan or $200 on a $20,000 loan. When shopping around for student loans, borrowers should look to see if their lender is charging origination fees. Many federally issued loans, including Stafford loans, have up to a 1% origination fee for each loan disbursement. Many private loan lenders have decided to waive origination fees on student loans and student loan consolidations as an incentive to students. What is loan underwriting? Underwriting is the process of deciding what makes an applicant eligible for a loan, based on factors including credit history and other considerations such as income, debt, and employment. Each lender has its own underwriting team that works to approve loan applications based off preset lending criteria. Each lender's underwriting team will approve or deny a loan application based on documentation provided during the application process. For example, underwriters might specify that a borrower has to have a certain amount of annual income and ask the loan applicant to provide several official pay stubs in order to verify that income. Usually, lenders accept this documentation online for easy submission. Strong underwriting standards are important for a few reasons, the most important of which is loan quality. It's in the best interest of the lender and the borrower to only approve applications for borrowers who can repay the loans. If you've recently applied for a student loan or for student loan consolidation, you were probably asked to sign a promissory note. So enough with the financial jargon. What is a promissory note? We explain a promissory note, or a P-note more informally, as your loan's contract. Like other lending disclosures, the promissory note is an important document. The promissory note will essentially explain the rules and functions of the loan. The promissory note records your commitment as a borrower to repay your lender what you've borrowed on your student loan. Now, the promissory note will clearly reference the terms and repayment options available and agreed upon by the borrower and the lender. You should make sure that the terms in the promissory note match your financial objectives before signing. If you ever have a question about how your student loan must be repaid, the answer will be housed within the note. More specifically, the promissory note includes both basic repayment details and more financially specific details on how your student loan is structured. Now, different student loan lenders may show you your promissory at different points in the application process, but everyone signs a promissory note. It is industry standard. What's the difference between a deferred payment plan and an interest-only payment plan? Most lenders offer borrowers at least 2 payment options for the repayment of their loans. Most student loan lenders allow students to select a deferred payment option. With the deferred payment plan, borrowers will have no required payments while in school. This could be a great option for students looking to concentrate all of their attention on their schoolwork without worrying about interest payments. Interest will accumulate and will be added to the balance of the loan. With interest-only payment options, student loan lenders allow borrowers the option to pay back their interest while in school. Students that do decide to pay interest while in school can enjoy average savings of over 20% on the total cost of their loan when compared to deferred repayment options. Moreover, some lenders even give student interest rate discounts if they elect to pay their interest while taking classes. These are the 2 most common repayment options available to borrowers. Some lenders may have additional options available for borrowers. Private student loan consolidation allows borrowers the ability to consolidate and refinance one or multiple loans into one loan at a potentially lower interest rate. Consolidating is the process of combining multiple loans into a single loan and monthly payment. Consolidation is a great tool to use if you would like to lower your monthly payment. Refinancing is the process of reducing the interest rate of an existing loan. Refinancing loans is a great option for borrowers who have good credit and would like to save in interest. Borrowers can both consolidate and refinance through private student loan consolidation. There are some borrowers who stand to gain from applying with only one private student loan because they're simply interested in refinancing. Likewise, there are borrowers who are interested in applying with multiple loans even if their interest rate does not change because they're interested in consolidating. Thanks for taking the time to watch our video series. We hope you enjoyed the topics covered. If you would like more in-depth explanations of any of the topics covered in the series, head on over to the resources section at LendEDU.com. If you have feedback and would like to share it with the LendEDU team, you may reach out directly using the Contact Us form found at our website, LendEDU.com.